Good evening to all. Thank you for joining us today for Thyrocare's earnings conference call for the first quarter of the year FY2024. Today, we have with us Mr. Rahul Gua, MD and CEO, and Mr. Aditya Shinde, VP Finance, to share highlights of the business and financials for the quarter. I hope you have gone through our results release quarterly earnings presentation. They are now uploaded on the stock exchange website. The transcript of this call will be available in a week's time on the company's website. Please note that today's discussion may be forward-looking in nature and must be viewed in relation to the risks pertaining to our business. After the end of this call, in case you have any further questions, please feel free to reach out to the investor relations team. I now hand over the call to Mr. Rahul Gua to make the opening remarks.
Thank you, Prateek. Welcome, evening, and a warm welcome to all on the call. Thank you for making time out on the evening time to join us. My name is Rahul Gua. I'm the MD and CEO of Thyrocare, and will take this opportunity to present the Q1 results of FY2024. As Prateek said, I'm joined with Aditya Shinde, who is our VP Finance, who will take us through numbers, and Prateek, who is part of our strategy team and leads investor relations. As always, before we begin, I will start with the quote of the Mahatma: "The future depends on what we do today." So I wanted to give some of the highlights of what we've been up to in the last quarter. I'll start off with some good news. We have received payments of 58 crore from NHM for the testing done during the COVID period. We still have an outstanding of about 13 crores, which has been provisioned in the book. Another big change that we implemented this quarter is a pay-for-performance pricing structure. Earlier, our discount structure was one size fits all. So now we have moved to a slab-based pricing model, which we implemented in May of 2023. This has led to an increased energy with our franchisee network, with motivation to move up volume and enter higher slabs. This has resulted in both volume and value growth in this quarter. Our efforts in our franchisee business to go deeper into India, focus test menu continues, and this quarter we added 385 transacting franchises. We also continue to selectively expand our offering. As I had shared last quarter, we launched Janch Packages, which is our investigative or sickness brand. Just to remind all of you, our Janch lineup is targeted towards lifestyle challenges or for you to better understand your health. We have solutions across the spectrum for anything you might be worried about. Is it fever or something more serious? Why is my hair falling? Might I have cancer through our cancer screening, as well as deep investigations for common chronic diseases like diabetes, heart health, PCOS, amongst others. However, our partnerships business saw a decline, as I mentioned earlier, largely because of API and the closure of our MCGM contract. The API group revenues and MCGM together account for 6 crores of degrowth in business. Some of the other health tech partners also faced degrowth. However, that gap was filled by onboarding new clients, and overall the partnership business has remained steady. Our margins have expanded this quarter, primarily due to gross margin expansion because of improved efficiency of the new machines, exit of lower margin government business, and our costs have remained controlled year on year, with both manpower and overhead more or less flat versus last year. Radiology business did a revenue growth of 30% year on year, and overall we did a 6% year on year revenue growth. With that, I'll hand over to Aditya to cover the results.
Thanks, Rahul. Good evening, everyone. I'll briefly update you about the key highlights of Q1 FY2024 financial performance. Before we get into the details, I'll reiterate something we've been telling for a few quarters now about the ESOP program that we've been mentioning. This program has been introduced by the API Group to retain talent at Thyrocare. The ESOPs of parent company will vest a period of years, out of which one has already passed. We have 5 more to go. And we are recognizing the same as per the Indus IFRS as a book entry. It was a share-based payment. The total value of the ESOP is close to 45.53 crores to be created over a period of years. Out of these 45 crores, we already provisioned 22 crores. So there is only half way to go. But one thing we all know that this is a cashless charge being an ESOP. It is in no way affecting my cash flow. And as per India's the option value at the date as per black goes. This is a charge to the PL over the vesting period. The breakup of this 35 crores year-wise is given in a quarterly presentation. As these are not operating expenses and do not impact the cash flow of the company, we have normalized the EBITDA which to account along with the provision for RDD. Along with this, I'll also like to say that this doesn't dilute the Thyrocare equity in any way. So even after the 5-year period, whenever the ESOPs are vested, it will not impact the Thyrocare equity in any way. Go into the performance. Our overall revenue saw a growth of 6% YOY related, and this has been driven by a 15% growth in our base business. As far as EBITDA margin is concerned, a standalone EBITDA at a normalized level stands at 33% versus 59% same quarter last year. EBITDA margins in our radiology segment stood at 12% versus 20% same quarter last year. There has been a dip in the EBITDA margins in radiology because of increased CM costs and reduced gross margins. While a consolidated normalized EBITDA margin stands at 31% versus 30% same quarter last year, which is a 15% YOY growth in EBITDA margins. These brief highlights, I'll back to our Indian CEO, Mr. Rahul Gua, for the strategic updates. Thank you.
Thank you, Aditya. I'll just once again take a few minutes to recap our strategic direction and then we'll go into Q&A. First, as always, our value proposition to the customer. We will continue to remain an affordable option to all patients with good quality and on-time reports. All our efforts on our value proposition is towards ensuring this low-cost patient, assurance on quality of testing to our certifications and engagements with doctors. We have made substantial progress on this, which I have stated in my initial comments, and is also reflected in the presentation in the chapter on raising the bar on quality. This remains at our core and will guide all that we do. Second, our strategy. We continue to remain the B2B partner of choice to all front-end diagnostic services companies in India. Whether it is a small diagnostic center in a semi-urban area, a pharmacy in a metro, a small nursing home, an individual doctor, or a leading online diagnostics platform or health tech marketplace. We are happy to provide low-cost, robust testing solutions to ensure that they can serve their patients in the most effective manner. If they require phlebotomy, we are happy to mobilize our phlebotomy network to almost 900 companies and 400 network phlebotomists to serve them. Strategy has been working well for us with our franchise business at an all-time high, and hopefully the headwinds in the e-commerce space will abate and our partnerships business will be back on a strong growth trajectory. As I outlined last time in our strategy, we have 3 key pillars of growth. The first is our franchise business. The focus is to take our franchise business deeper into India. As I have shared, we are actually largely tier 2 plus as an organization, and we will continue to go deeper into India with a focused test menu and provide our clients with a frictionless experience to transact with us and provide their customers the best testing experience that they have. We will continue to focus on private as well as public partnerships. In the public space, we will focus on TB and infectious disease, where we are by far one of the strongest players in this segment. Additionally, we will continue to expand our partnerships across healthcare companies, hospitals, and other health services companies to enable them to provide diagnostic testing to their customers. The third area is new for us. As I said, we have a strong and robust B2B model with a core of execution. Believe there is a lot of opportunity to take this model internationally, and we'll start to look at emerging markets where we can bring this model to provide affordable testing into these emerging markets. As I mentioned, we are on track to have our operations in Africa start by the end of this year, and I am hopeful after that we will look at newer opportunities to expand the international. That in a brief is our mandate as management. Thank you for giving us a patient hearing. I'll once again end with a quote from the Mahatma, which I always do. Find purpose, means will follow. And as always, our purpose remains to provide affordable, high-quality testing to the masses. So with that, we'll open up for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use hands while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Rahul Agarwal from Red Capital. Please go ahead.
Hi, good evening, and thank you for the opportunity. Questions firstly on the ships. Is it normal, like should we assume 22 crores of rate going forward as sustainable?
See, hi Rahul. I think, look, I don't think that it is, I would say, 32 is an anomaly. We haven't had the time to, plug government contracts since we lost the MCGM contract. So I would say, in the 35 range would be the new norm.
Okay, I get it. Secondly, on price hike, the presentation mentioned about some hike in the quarter. Just wanted to clarify, was this hike done on specific tests or it was largely a mixed impact?
Actually, as I mentioned, Rahul, in the beginning, we moved from a base of performance structure. So earlier, we used to have a universal discount, regardless of whether you were a small client or a large client. So what we have done is moved to a graded discount or a slab-based discount structure. So as a result, some of the smaller clients saw a higher price hike, and the larger clients did not. So that's what you see there. So it's not really mixed. It was across the board, more determined by how large the client you were.
Got it. The number should continue ahead as well, right? Because the system is changed permanently. This should be retained by the company, right?
Yes.
Okay, get it. And just on MCGM, when did this contract actually close, and what was the revenue number for fiscal 23?
So it was roughly 1 crore a month, and it closed on 4th April.
Okay. And is it worth discussing Pulse High-Tech financials? I think it's consolidated in nuclear. I know it's very small. What contribution and potential ahead for the business?
See, it's only one center. As I've shared in the last couple of calls, it's a pilot that we are doing in the radiology business. It's too small to spend time on it just now.
And last question is on tax rates. The effective tax for the quarter is 1%. Any adjustments done here, or is it like it's up to 55 the full year?
Aditya, do you want to take that?
Yeah. Hi, Rahul. So yeah, there have been a different this time. It should normalize to 26% plus or minus to going on a thing.
What are the contracts that adjust, please?
So the debt tax asset has been roughly 3.5 to 4 crores taken this quarter.
Okay, I get it.
Thank you.
Thank you. Ladies and gentlemen, if you want to ask a question, you may please press star and 1. To ask a question, please press star 1 at this time. To ask a question, ladies and gentlemen, you may press star and 1. The next question from the line of Rahul Agarwal from InCred Capital. Go ahead.
Sorry, I thought I'll continue with the concession at the point you guys enter the queue. One on Rahul, you mentioned some other health platforms apart from API also do. Could you explain how the market actually shaping up? Because these are the guys who are hard across B2C, and the entire industry had some issues around pricing and competition. Just elaborate a bit what is really happening in the market.
Yeah. See, I would not want to name specific companies. I would say the partnerships are. It really depends on what is the nature of the partner. I would say the more services driven partners have been largely stable. The more product supply driven partners, that is where the benefits come.
Okay. Get it. So it's more like pure creators have grown. Is that correct?
Yes. Yeah, I would put it that way.
Okay, get it. And on Africa, you want to talk a bit more, as in, obviously it starts by year end, but how are we going about the network there? Like, have we hired people? How are we doing the network there?
For Africa, there is a team on the ground right now finalizing the lab location and the equipment orders. We have a JV partner who is actually helping us with the market development part of the business. They are a very large distributor in that country, and they will be helping us with market development. We are in the process of actually hiring that sales team.
Okay, get it. Thank you.
Thank you. The next question is from the line of Khalil Randeria from Ruliad. Go ahead.
Yeah, hi. My question is really on the strategy of going to Africa. And is this the first of others to come? And so let's start with that, and I can take the second one on.
Sure. I had in the last call identified 3 regions that we would be looking at. Okay. Africa was one, Middle East was second, and Southeast Asia was third. So our foray in Africa, the first foray in Africa is this year. Once we are able to, wrap our minds around, this part of the business, then we would look at Middle East.
Okay. And I would imagine you would have some sort of advantage over here, is why you wanted to get in here, and if you could narrate a few of them.
Sure. So, one is, actually it is about replicating our India competitive advantage, which is, low cost, good quality testing through a centralized network at high scale, right? That allows us to bring the prices down substantially in these markets, and that is the strategy that there has been built on. We are effectively replicating that same strategy in Africa, where there is a large out-of-pocket, patient population. So therefore, they are always looking for an affordable option, and it allows us to take the India model, which has worked very well, into that market.
Pricing would be similar over there, or it's much higher?
Pricing is much higher currently. On average, the pricing from our market study has been almost 3x India rate. But the cost structure also, tends to be higher. But we believe, with a large-scale centralized lab, we should be able to go in and bring costs to the patient down substantially.
Sure. And, in terms of working capital, is there anything over here, or would it all direct to you, or would you have an entity and will have a working capital need to yeah.
So we're setting a JV operation there. So, the invoicing will happen in the JV. to a large extent, you're running a B2B model, particularly with focus on, hospitals and servicing other diagnostic labs for the outsourced needs. You require a certain amount of working capital. It is in the 30 to 60 days range, not more than that.
All right. My second part of the question is really on, you had mentioned that there's you'll have reset margins to a certain level. And, you also see that you continue to remain to be a low-cost, one of the lowest-cost providers of this business. How do you expect that to play out, over the next 24 months, given that you had substantial time that you Thyrocare already so far?
Sure. Hold on. It's 15 months at Thyrocare, yes. If you see quarter on quarter or year on year, if you compare versus quarter one of last year versus quarter one of this year, our manpower cost, our employee expenses, and our other expenses are more or less flat. We've not allowed any or very tiny increase in that cost structure. And therefore, with the pricing strategy that we have in the market and all of that, we've been able to also improve EBITDA margin quite healthily, I would say, over the last year. Of course, one should not expect kind of trend as we move into the next year. But I do believe that we will continue to remain sharply on our costs and ensure that operating leverage comes through.
So, you earlier when the company was running it was more like a 40% odd number. Is that anywhere on the horizon? Do you think this is a more or less permanently?
So as I said, when it was a 40% EBITDA business, and I think this quarter we exited Thyrocare standalone at 33, right? So the gap is about 7%. That investment in EBITDA has gone into two areas. One is expanding our lab network. And so earlier we had a much more consolidated lab network. In today's competitive environment, turnaround time of at least 24 hours is required. Our turnaround time, if you see in the presentation, could go as high as 48 hours. So that is one investment that we have made in ensuring that we are able to bring our all-India turnaround time to 24 hours. That results in higher rental costs and all of that as in our cost structure. And the second investment that we have made is largely on the quality side. Actually, very few of our labs had pathologists. Today, all our labs have pathologists doing the operations and are able to interact with doctors so that if they have any queries or complaints, they can address them in a timely manner. And that cost structure, is an investment that we have made. So we've made two large investments. One is in our lab network, and the other is in our quality, particularly when it comes to having pathologists in each of our labs. So I think if you were to ask me, will we go back to 40%? I think that will be a difficult journey. However, I do see scope for still some margin expansion from where we are today.
Thank you.
We have the next question on the line of Saurabh Shroff from QRC Investment. Please go ahead.
Yes, hi, good evening. My first question is on the ESOPs. I'm not sure if you all have covered it in the past, but the reason why the management is taking ESOP in an unlisted parent rather than the listed company?
That is how it was structured at the time. That was, the parent company at the time was to be listed very shortly. And it was felt that instead of diluting the Thyrocare shareholders, who at that point the management was quite new to this organization, it was felt that it would be best to, create the ESOP pool at parent. As you know, Thyrocare has an ESOP pool already in place, but it is quite limited in the number of options, and it was also quite restrictive in terms of grant period and the exercise period and so on. So therefore, overall, I think the group needed to grant options at the group level, and that was a call taken at that time.
So if for whatever reason the parent does an IPO, that is still no fallback or the management to get compensated for the good work that they will do with Thyrocare in any way. Essentially, the management is running the risk of not getting compensated if for whatever reason the IPO doesn't happen. Is that fair to understand?
Yeah, I would say that could be a risk overall.
And secondly, I guess just something back on the slowdown in the business from the parent. You said that you expect this to normalize over time. I didn't catch the run rate that you think that you mentioned that we should work with.
So I had said, we should normalize at about 35. Actually, that is because we have been bidding very aggressively for a number of government contracts. Some of them hopefully will come through in this quarter or the next. I anticipate at the API group level, it will remain at the level that it is, which is, roughly about 4 crores a month. I think that's the range that it will remain at. It used to be about between 5 and 5.5 in its peak. But I don't expect it to go below 4, but I think it will be a while before it recovers back to 5.
Okay, and on the partnership business, what is the split between government and non-government? I know there has been a lot of government business, but is this something that sort of solves for? Because I would imagine government business is not at the same margins, right? Or is it?
No, the government business is at a substantially lower margin. Actually, in that, after the COVID business that we had done, the only government business that we had was our TP business, which continues, and the MCGM contract. MCGM, as I shared, was roughly 1 crore a month, and our TP is roughly about 3 lakhs, I think, a month. So you could say about 4.5 crores in that 32 crores is our government business. In that 38 crores is our government business, of which 3 crores is completely gone.
Oh, all right. That's where you are saying it should come back to that 35 kind of.
Yeah.
Okay. Thank you very much.
Thank you. The next question is from the line of Amit Agarwal from Leeway Investment. Please go ahead.
Hello. Can you hear me? I just have a general question. What is the business model in advanced countries like US or Japan? So I don't think they have a system of calling a clinic and ask for test. So there, or what is this business model? Yes, I don't know.
So I'll take up the question a little bit, Amit. I think in the US and in many developed markets where the entire health system is reimbursed, right? Actually, a lot of the diagnostic testing is largely controlled by I wouldn't say controlled, but largely mandated either as part of the annual health checkup of your insurance company or with the doctor, right? And that is because, those are largely reimbursed economies. In India and a few of the emerging markets that I highlighted, it is very much a self-pay market, where effectively you go and pay for your doctor visit, you pay for your you pay for your diagnostic test, you pay for your medicines out of pocket, right? And in this kind of economy or in kind of healthcare system, actually having good diagnostics plays a very critical role, because the early, as they say, in time saves 9. We all know the difference between diagnosing diabetes early versus late, cancer versus early versus late. So at least it is my view that in emerging markets, diagnostics will continue and for as long as I can see it, play a very critical role in helping patients identify diseases early, helping governments also manage the cost of care with early diagnosis. So I don't think, I do believe the business model of diagnostic testing out of pocket is of course largely prevalent in emerging markets, as is branded generics and other healthcare nuances that are largely related to out of pocket markets. But I think in out of pocket markets, you will see that diagnostics plays a very critical role.
What is it? I Google is also entering into testing, and soon it will have an AI model which is all the testing in the future. Is it possible? And can I buy some kit in the future to test my cholesterol or diabetes or something like this? Can this market will shrink? Or in some
No, see, many of these tests still require final confirmation through a diagnostic test. If I take the example of HbA1c, you get HbA1c kits that are, very much like the rapid kits that we used during COVID, where you can do a skin prick and get a reading of the HbA1c. But in 99 or 100% of those cases, if you have elevated HbA1c or even normal HbA1c, most people will recommend that you do a confirmatory test, right? And some of these are, I would say, more screening rather than confirmatory technologies. So I think if you're diabetic, you will need to do an HbA1c once every 6 months the rest of your life. Yes, the first time you may be able to do a quick iPhone camera and see that you may be diabetic or at risk of diabetes. But the testing life cycle is very, very long when you're a chronic patient.
But because in India we get testing after 6 months or 1 year, just a normal test for all the in the body. Just a health checkup. So can this over market shrink? Just a possibility. What is the answer to that?
See, I think we are far away from a single technology like a phone-based platform replacing all the possible health parameters in a health checkup. The technology could be advanced to a point where you may be able to do screening for very specific 1 or 2 largely diabetic parameters, right? But I think we are a long way from an annual health checkup happening on the phone.
Okay, thank you. That's it from my side.
Thank you.
Thank you.
Wish to ask questions, please press star and 1. The next question is from the line of Aditya Kemka from Incred Asset Management. Go ahead.
Yeah. Hi, Rahul. Just a question on the partnership business again. Just understand
I think there has been a movement towards a path to profitability, as with actually most of our healthcare platforms. So I think the burn model or, the deep discount model has pulled back substantially, right? And as a result, volumes have come down. And actually, I've seen that across, as I shared, across most of the, aggregator or product-based marketplaces, where they have pulled down substantially the discounts, and as a result, have seen a paring down of volumes.
So it's mostly volume driven, and I can see that in your presentation as well. So API understood. What was the challenge on the B2G side? Given the numbers that you have spoken, and it's not only in the API business, there's a trend on the B2G business as well. So understand a little better on what's happening there.
That is, as I mentioned, the MCGM tender, which used to account for about 1 crore a month of our business. That tender, when it came for renewal, the pricing that was there was we had quoted our best possible rate protecting our margin, and we lost the tender. Go below that, what we had bid didn't make sense for us, so we didn't have that tender. Also, given that we had so much government receivables in the last quarter, we were very cautious about what we would bid for and what we would go after. I think now, with a lot of the government receivables having come in and with line of sight on at least many of our payments, I think now we are more comfortable looking at this business and seeing how we can participate more strongly.
Got it. So speaking API and government business, for the B2B channel, the numbers seem to then return, right? Because we lost 1 crore a month on government and 1 crore a month on API. So that's a 6 crore difference we can see YOY. But I understand. Now, coming to the rest of the government API, why was there no growth? It was YOY flat. So, even if you haven't added partners, your existing partners would have given you higher volume YOY, right? So, what exactly went wrong there?
Yeah, so as I mentioned, API is one of our partners, which I can talk about because, in the way they are our friend. But we had a multiple of other partners whose volume also pulled back, right? But we were able to cover it up by adding new partners and getting that business flat. As you know, Aditya, also Q4 tends to be the best quarter for partnerships because we get into the annual health check and all of that. So the fact that we were able to maintain between the non-API, non-B2G partnerships at the same level as Q4 of FY23 was also reasonably good.
Yeah, I get that. Coming to the B2C business, right? I see something of 50%, so that's 7.4. I see a workload growth of about 30%, so 1 crore samples going to 1.6 crore samples. Realizations drop there. So in an environment where we tech companies are reducing discounts and moving to profitability, on our B2C franchises, our realizations are dropping. So just want to understand better what the strategy there is.
No, actually, that's I can explain it. I'll try to simplify it as much as possible. One of the things that we launched was upsell for our D2C platform. So if you place an order on Thyrocare, typically the Flavor would ask you if you would like to add 1 or 2 additional tests at the time of collection. Those tests get collected in another sample. So effectively, what you're seeing there is the additional test getting added on, which is getting reflected as higher volume. But if there was a 1,000 rupee package and you added a 300 rupee test at the time of collection, yes, on a per sample basis, the realization has gone down. But you will find on a per patient basis, our realization has gone up.
Right. So the right way to look at it is not really on a per sample or workload basis, but to look at it on a per patient basis.
Yes.
Maybe that should be sharing in tech, right? terms of you may not have that clarity on BTG. Got it. Let me get that. Sorry. I understand that. Yeah, I get it. So Rahul, with only 6% top line growth, for various reasons, in the first quarter, how would you guide us to your FY24 top line, market doesn't seem to be growing at what we call growth from the market. Pin code driven growth is there because your size business is growing, but not the rate that we had. So what would you believe would be your guidance for FY24 in terms of top line?
I think our franchise business grew 16% year on year, right? If you look at, and if you see our franchise business, it has even grown over Q4 of last year. So both, if you look year on year, it was 16%, and Q4, which typically tends to be the best quarter, we've done better than that in this quarter as well. So I am quite bullish about the franchise business and its prospects. I would expect to sustain, the growth that we've seen in the first quarter through the year. I expect that in partnerships, we can get back to a 35 average, right? I would be happy of where we are. So I think the weighted average of that would probably land you at about 12-8%, overall.
12-8%. And in terms of margins, I heard you say that there is still scope for improvement. I must commend you on the margins that you're doing at least on a basis once we cut out the soft cost. So on the margin side, 31% for the quarter, am I right? What would you say, would our full year margins look?
I would say in that range, plus minus 1%.
Got it. One last question. So you mentioned you received money from the government, and I believe some of this was provisioned for. So I don't see a right back of provisions in the financial statement. Please help me on this front. What is there?
I can take it, and I'll ask Aditya to add on. We are still waiting for, as I said, there is still some payment left, right? So the entire receivables now has been provisioned. We're just waiting for the final closure on the payments to evaluate. It's just right back. We wanted to do it in one shot. We're just waiting. I think we'll get complete clarity at the end of this quarter, and we'll take a call then. Do you have anything to add?
Yeah, that's right. So, okay. We are fully provisioned. In fact, we are over provisioned, but then before we write back and reverse these provisions, we would like to wait at least 2 quarters to get a full view of, how much final settlement coming from the government party, especially the NHM project. That visibility is there. We'll be proceeding with that or reversal of these provisions.
Yeah, but a question, Aditya, even in this quarter, we have provided another 1.3 crores. So is this not related to the government?
Related to the government. So typically we provide, this is an ECL model, and this is our with the statutory auditors. So this is that 0.29 is towards government, because we still have 9.9 crores of government receivables, and part of it is also for the corporate that we drive into. So, yeah.
So I have one question. Can you guide us to your full year for this year, and what is our current cash or net debt position, if you can guide help us with that?
I'll say you can that.
Sure. So for FY23, we did close to 40 crores of CapEx. In FY24 as well.
You are guiding for FY24, right?
I'm guiding for FY24. So FY23 we did 40. FY24 we should be doing close to 45 crores. Out of which in Q1 we have already spent 50 crores. All right. So balance we spend towards maintenance CapEx, tune of 50 crores, and another 10 crores for overhauling our IT infrastructure and lab physical calendar. another 10 crores for the international expansion. So overall 45 crores is what we are budgeting this year towards, and out of the 45, 11.8 has been in Q1 23. Yeah.
Current cash position?
Currently, we are sitting on a cash of 80 crores, both Aero and NHL put together.
80.
80, correct. That's right. Okay. And these are parked in the technical funds.
Yeah, I get that. So, Rahul, I have one more because I hope there are no people waiting in the queue. The B2C side, obviously, when we look at the other companies, they have a fairly profitable B2C model. Could you talk to us a little about what initiatives we are taking on the B2C side? I know it's a small baby right now, but this model definitely has potential. So, can you talk to us about what you're doing, what the initiatives that you think, and what is your right to win in the B2C space?
Yeah. So on the D2C side, to a large extent, we are learning from our partners in the D2C side of the business or the partnerships, where all of them run a number of health tech platforms. We're learning from all of them. For example, most of the growth that you've seen over the last year in our D2C has come largely organically, mostly through remarketing, which we have effectively learned, going back to our old customers, being able to mine the data and see when it is time for them to retest. That has worked very well for us. The other was what we call multi-patient, or adding more patients to the same order. And as I talked about, also what we call upsell, which is at the time of selection, asking the patient if they would like to add any other tests and so on. We have still not reached the point, Aditya, where it makes sense, marketing dollars behind this, because the ROI is still, the cost per lead acquisition on Google and Facebook and all of them still remains exorbitantly high. So we still haven't invested in the what you would call marketing burn model, or the marketing led model. We're trying to maximize the organic traffic that we have right now, and also leveraging our franchise business along with our online business, be able to service orders deeper and deeper in the country.
Yeah, that's for me and all the rest.
Thank you.
Thank you.
The next question is from the line of Rahul Agarwal from Capital. Please go ahead.
Hi. The NABL accreditation has done largely 20 of 31, or we are looking for more accreditations?
I think 20 out of 31 are our largest labs, and now we are at almost 85% of our samples processed in a lab, an NABL lab. What you should know also is NABL is a bi-yearly process. So, almost every lab will go for their NABL renewal either this year or in the next year. So that keeps us on our toes. I don't anticipate to increase this number beyond 24.
Got it. And last question from my side was, you mentioned we're trying to recoup partnership business through paying for some new government contracts. I'm assuming, and correct me if I'm wrong, that these contracts will actually be bid by the partner and not care, and hence the entire bidding risk is on them and not us. Is that correct?
No, in the government business, we have to participate as the principal. So we will be billing, and billing risk will be with us. But we are being cautious, as I mentioned, focusing on areas where we have a right to win and are our strength, particularly in TB and infectious disease. And so that's where we have actually limited the scope of participation in the government contracts.
Oh, okay. So this is not in partnership with any, is it direct Thyrocare going and bidding for new contracts, which obviously you have to be very conservative on this. Is that correct?
That's correct.
Perfect. Thank you so much for answering my questions. All the best.
Thank you.
There are no further questions. I would now like to hand the conference over to Mr. Thyrocare for closing comments. Over to you, sir.
Thank you, ladies and gentlemen. On behalf of Thyrocare Technologies, that concludes this conference. Thank you all for joining us.